Bonds Explained 101 is a comprehensive guide to understanding the concept of bonds and how they work in the financial market. A bond is a type of investment where an investor loans money to a borrower, typically a corporation or government entity, in exchange for regular interest payments and the return of their principal investment. The borrower issues the bond to raise capital for various purposes, such as financing a project or refinancing debt. The bond is essentially a contract between the borrower and the investor, outlining the terms of the loan, including the interest rate, maturity date, and repayment terms. There are several types of bonds, including government bonds, corporate bonds, and municipal bonds. Government bonds are issued by governments to finance their activities, while corporate bonds are issued by companies to raise capital for their operations. Municipal bonds are issued by local governments and other public entities to finance infrastructure projects. When an investor buys a bond, they essentially become a creditor to the borrower. The borrower makes regular interest payments to the investor, known as coupon payments, until the bond matures. At maturity, the borrower repays the principal amount to the investor. The interest rate on a bond is determined by the creditworthiness of the borrower and the prevailing market conditions. Bonds with higher credit ratings typically offer lower interest rates, while bonds with lower credit ratings offer higher interest rates to compensate for the increased risk. Investing in bonds can provide a relatively stable source of income and a low-risk investment option. However, bonds also come with some risks, such as credit risk, interest rate risk, and inflation risk. Credit risk refers to the risk that the borrower may default on their payments, while interest rate risk refers to the risk that changes in interest rates may affect the value of the bond. Inflation risk refers to the risk that inflation may erode the purchasing power of the bonds, interest payments, and principal amount. To mitigate these risks, investors can diversify their bond portfolio by investing in a range of bonds with different credit ratings, maturity dates, and interest rates. It is also essential to conduct thorough research and analysis before investing in bonds, taking into account factors such as the borrower's credit history, financial performance, and market conditions. In conclusion, bonds are a type of investment that offers a relatively stable source of income and a low-risk investment option. Understanding the different types of bonds, how they work, and the associated risks is essential for making informed investment decisions. By following best practices, such as diversifying your portfolio and conducting thorough research, you can make the most of your bond investments and achieve your financial goals.